Hello folks, Todd Halleck here today to talk to you about qualified charitable distributions, QCDs for short. Just attended last week the Gift Planning Council conference that happens every 2 years, put on by the Philanthropies Department of the Church of Jesus Christ of Latter-day Saints. We learned a lot about reasons for giving, opportunities for giving, and some of the tax benefits associated with giving. And one of the great discussions last week was on the subject of qualified charitable distributions. You know, several years ago when I attended that conference, the esteemed Arthur Brooks was a speaker, and he talked about one of the best reasons for giving is that it makes us happier. The studies they've done show that by giving, it makes us happier. And I'm here to testify that that is absolutely true. And if giving makes us happier, giving and saving a little taxes makes us even more happy. And the QCD is just that. It's a great opportunity to support your favorite charity, but also benefit in a great way from an income tax standpoint. So what is a QCD, or qualified charitable distribution? It's really simply just a direct transfer from your retirement account, and it's got to be an IRA, your retirement account, to a qualified charity. And we'll talk a little bit more in a second as to what constitutes or what doesn't constitute a qualified charity. But it's got to be directly. It can't come to you first and then you turn around and make the donation like you maybe traditionally do with charitable donations from your retirement account. And the reason is by doing it this way, it excludes the amount from your taxable income. It in effect becomes an above the line deduction. So instead of taking the money out of the retirement account, having it added to your taxable income, and then making a distribution that if you're not, if you're itemizing, you get to take a deduction of some percentage of that amount. The entire amount that goes to the charity does not affect your taxable income. So in effect, it's almost like it's a dollar for dollar deduction of that amount. You really can't get that many places. And like I say, you don't have to itemize it, so it doesn't matter whether you're itemizing deductions or whether you're below the standard deduction. It's a win-win in that respect. What are the requirements? Well, as you may know, there is a required beginning date, and when you hit that required beginning date, you are required to make required minimum distributions to you each year. Before the advent of the Secure Act in 2020, that required beginning date was the year you turned age 70 and a half. And the QCD's been with us for quite a while, and it was tied to that age 70 and a half required beginning date. When Secure Act went into effect in 2020, while it increased the required beginning date, the age for the required beginning date, it did not increase the age for the qualified charitable distributions. So regardless of whether your required beginning date was age 70 and a half, 72, or under the current law, 73, the age for eligibility for the QCD is age 70 and a half. So as long as you're at least 70 and a half, you can put up to $100,000 per year, or you can do qualified charitable distributions of up to $100,000 per year. So a husband and wife, if they have enough in their respective accounts, could effectively do $200,000 in a given year, $100,000 for each spouse. Starting in 2024, that number will be indexed to inflation. It's been at $100,000 for as long as I can remember. It will start to increase in 2024 based on inflation adjustments. If you have reached an age where you're taking RMDs, required minimum distributions, the benefit of the QCD gets even better because it counts towards your required minimum distribution, as long as the amount comes out prior to December 31st. So in addition to basically getting a dollar for dollar deduction, it also reduces potentially down to zero, depending on the size of your required minimum distribution, the amount of the required minimum distribution that you're required to take out, which also in effect reduces the amount that if you leave this asset to your children that they're going to be subject to income tax on. So understand this, however, with changes to the Secure, or with the advent of the Secure Act back in 2020, now people can continue to make contributions to their IRA even after they reach their required beginning date. If you make contributions to your IRA during a given year, it may reduce or eliminate your ability to do a qualified charitable distribution. So it's always important to get good income tax advice as you're moving down this path of making qualified charitable distributions, especially if you're continuing to do it in conjunction with contributions to the IRA. Like I said earlier, the charity that it's going to must be a qualified charity, and that's generally speaking going to be a 501c3 corporate or an entity that's tax exempt under 501c3. There are certain kinds of institutions that we commonly give to that we are not able to do qualified charitable distributions to. A private foundation, a donor advised fund, a supporting organization. Those institutions cannot be recipients of a qualified charitable distribution. And last but not least, there's been a recent case about this where a qualified charitable distribution was disallowed. Just like any other donation, charitable donation, you must receive a contemporaneous acknowledgement from the charity. If you don't receive that acknowledgement, your qualified charitable distribution may not count. So as we're heading into the end of the year, just a month and a half about left before December 31st, if you haven't heard of QCDs and you're over 70 and a half, I'd really encourage you to talk to your accountant about whether you could benefit from this great planning technique.